money radio for a really great future. We're talking real money.
You know, it's really nice when we're able to state things that, you know, it's just like does. I like to call them that. Does. Things that just always end up being true. Over and over and over again. And a couple of those things that end up being true, we talked about one of them in the last hour, and that is you could try to beat the market, but the evidence says, generally speaking, you're not going to do it. And the evidence shows that over and over and over again. Well, another thing the evidence keeps showing us is that as individuals, you can't even beat the market because you do dumb stuff. Welcome to Talking Real Money. I'm Don. That's Tom. We're here to talk about money. Our phone number is 855-935-TALK, 855-935-8255. And that call is free, and the information is free, and we love talking to you, and we've got lines open for you right now, so don't make us beg.
But we will beg eventually.
All right, we will eventually beg. I beg. I don't care. I have no pride. I will sacrifice it for phone calls.
Okay.
So,
go ahead.
Shall we talk about these universal truths?
Yes,
one of them is you can't control your behavior enough to even match what the market does.
The numbers I won't call them surprising because the first time I read the Dalbar study, 25 years ago?
Oh, gosh, that was a long time. I remember you guys.
I remember looking and going, what?
Yeah.
It was so shocking. And now Morningstar does the Mind the Gap study, which recently found that if you invested in all, exchange-traded funds and mutual funds, I'm assuming these are stock funds, that over the last decade you made 8.2%.
Mm-hmm.
That's pretty good.
Mm-hmm.
But if you are an investor...
But if you actually tried to buy and sell them yourself...
Yep. If you did this... I know.
You didn't do as well.
You only made 7%. Now, to many, people are going to say, well, that's only 1.2% a year. Yeah, try adding that up over 10 or 20 years. That is a lot of money. And worse than that, it turns out that basically the reason that people don't get market-like returns is they do it to themselves. They move in time. They move into markets. They move out of markets. They do all these really horrible things to themselves over and over and over again.
We hear it all the time. A great example is something, again, we talked about last show or last hour, and that is the U.S. international component of an equity portfolio. If you just followed the market itself, you would have done pretty well. But what we tend to do is we tend to go, well, those U.S. stocks are better now, so I'm just going to be heavily in those. And then you don't put any money in the internationals, and you end up regretting a period like the last year where international portfolios were up 20, 30+%.
And cash is another one. So right now, cash levels are the lowest as a percentage of assets under management in more than a decade. And in fact, cash levels are right about where they were in the year 2000. Does that year ring a bell?
It does ring a bell.
Yeah, it does ring a bell.
I think that was a very that was a bad time for the market.
Yeah, it was. And cash levels were very high in times like, well, let's say May 2000 after the market had gone down. December 2008, the market had gone down. June
By the way, December 2008, that was only 3 months before the market went up and never stopped for basically stopped for a long time.
Yeah, 2010 right on through. So, yeah, it's sad, it's horrible, but how do you deal with it if you're, and by the way, today, you want to get scared? Okay, we can scare you because, 38% of the S&P 500 is made up of 7 stocks. Mm-hmm. The NASDAQ has been going up, just up another 5% in October. Amazon went up 9% on Friday. I mean, crazy, right? I mean,
right. Wait. Are you going to tell me I should sell everything? It's been going up.
Get out. Sell it. You got that CD ladder program. Go to cash. No, we're kidding. Please do not do that. So, and I love this quote from Peter Lynch, who was very famous manager at Fidelity. He said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than have been lost in corrections.
That's an old quote.
It's very old quote,
Yeah,
but
it's an
very
old
true.
I thought maybe he was giving new quotes now.
Well,
No.
I think he's still quotable. He's still alive. He's hanging in there.
We as human beings think we know more than we can possibly know about one thing in particular. We think we can kind of sort of predict the future. We can look at the current situation and we are pretty sure what's going to happen next. Problem is we're not actually that good at it.
And when it comes to money, we're horrible at it.
We're horrible at it when it comes to everything, when you think about it.
Money is more painful because you think back, well, what if I had just held that for a long period of time? So going back to that, you need to know, and the bigger mistake I see today, the biggest is people are way too trusting of stocks. Just met with somebody who's retiring soon and 100% in stocks. Okay, then you got to be prepared for having a whole lot less when you retire. That just could happen, right? Because people have become, you said it when we were talking about this morning, way too trusting of stocks because all they've done in really recent past
Most
gone up.
Memory, yeah.
Oh, yeah, short. So it's horrible. Have the right asset allocation and don't mess with it, I guess would be the other one.
Our message is consistent. It's consistent and it's incredibly boring. You need to diversify. You're never going to know. 855-935-TALK call.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
And we want to talk about it with you. I'm Don McDonald with Tom Cock. This is Talking Real Money, the talk show / podcast. And we'd love to talk with you at 855-935-8255, which spells talk, T-A-L-K there at the end, 855-935-TALK. And let's go down to Pierce County and that lovely Bonnie Lake called Lake Bonnie. And Harvey, welcome to Talking Real
Bonnie
Money.
Mean? No, anyway, okay.
It means beautiful lake
Beautiful
or Bonnie
lake,
Lake or nice lake. I don't know.
I like
Hi,
it.
Harvey. Welcome.
Well, thank you. I've got a uniform gift to minor account. It's got about $31,000 in it now through Vanguard, and I've got the VTSAX is what I'm putting it in, and I would like to diversify that a little bit.
I'm sorry, you cut out
We lost
there
you.
at the end.
Yeah.
In what?
It's in VTSAX.
Yeah, the
account,
total market index.
Yeah, total
His
market.
radio's up. That's the problem.
That's diversified like crazy.
Yeah. What do you want to add to that? I mean, that takes in most of the globe stocks.
Well, I realize that, but didn't know whether I should go into like an account for years. One of those.
Oh, you're talking about a target date fund?
Yeah.
Who is this for? Who is this UGMA for?
My grandson. He's 16 now.
No, I wouldn't mess with it.
No. This is fine.
Yeah, it becomes his at the age of majority. which
18
means
in the great
you won't
state of
have any
Washington.
control after that. For a young person, if you can convince him to leave it alone for the rest of his natural life or until he retires,
or move it to a Roth,
that $31,000 could be a small fortune.
Yeah, I would leave it in the total market. I think it's a good fund. It's very low cost. It's well diversified. And if you put it in a target date fund, although
unless
what
it's
would
for
be
education.
the target date? Yeah,
unless
that's
it's for education. Is it
different
for
situation.
education?
No, he's looking at wanting to go to Sweden, and
he wants to spend it. He wants to spend it.
Move over there, go to school over there, and stay over there.
Okay, here's the deal. If he plans to spend it in his late teens or 20s, early
that's a
20s,
different topic, sure.
Then it should probably be put in something far more conservative. If this is money that he will know and agree to leave alone until he retires, then you can leave it in the VT wax. This is where that it depends part of our answer always comes into play. It depends on what the money is going to be used for. If it's money for the long haul, be aggressive. If it's money that is needed in the short term, don't take big risk.
But here's my question to you, Don. So if Harvey was going to say, well, the easy fix would be a target date fund, what year would you pick that might give you some fixed income in it?
2025, 2030.
Okay.
If he's going to use it soon.
Half and half, then that would be half stocks, half bonds.
Yeah.
So, I think that might be a reasonable strategy.
I figure he's got at least 10 years before he's going to be wanting to get into it.
Oh,
okay. Wow. If it's 10 years, then I would probably leave it alone.
Yep, me too.
Or go with a 2035 target date fund, 2035 or 2040.
Okay, appreciate it.
Okay. All right. Thank you so much for the call.
What a great gift.
We appreciate it. Nice gift.
Nice thing.
$31,000.
I wonder why. I should have asked why Sweden. That seems so out of left field.
Sounds cool to me.
You just were there, right? A year ago.
I like that part of the world. Yeah, so we were in Sweden and Norway and Denmark and loved Scandinavia.
40 years ago.
Love Scandinavia.
Yeah,
absolutely
beautiful place. Yeah.
I was there in the summer. I'm sure it's a totally different story in the winter.
Yes, I was there in the winter and it was cold. Yeah. It was kind of cold, kind of dark.
855-935-TALK is our phone number. Let's go to Lacey, Washington. And Rob, you're up. Welcome to Talking Real Money.
Hey, thanks for taking my call. My question is, I'm rolling over a TSP into a rollover traditional IRA. And my question is, I'm 43 years old and I'm wondering, if I should have bonds as part of my portfolio, and if so, what that percentage of the allocation should be. I don't have bonds in my Roth IRA. I generally understand what bonds are, but I don't really understand how the market works. And, I hear that you shouldn't invest in things that you don't understand. So I'm interested in your guys' thoughts on whether or not to have bonds, and if so, what's the allocation for my age?
Well, I don't think you'd have trouble understanding bonds because bonds are IOUs, right? They're pieces of paper that are
just going to pay you back. Loan.
Yeah, it's a different thing than a stock, which is investment in a company. So there's a guaranteed nature of having bonds. But here's my question to you. Have you taken anything like a risk quiz or tried to understand your emotions around investing?
I generally have a pretty high tolerance for risk. I understand things are going to go up and down, and you stay in. It's not about timing the market, but about time in the market. So I think I have a higher risk tolerance.
How long have you been investing, Rob?
It's been about 7 years.
Okay.
So you lived through 2020, lived through 2022 a little bit.
Did you stay invested in equities in 2020 and 2022 when we had those big market declines?
Absolutely, yeah.
Yeah, okay. All right. Cool.
At 43, in that case, no bonds. Yeah. I'd be all in stocks. Why not?
Yeah,
sure.
This is because bear in mind what you're looking at. These portfolios are definitely 20-plus year portfolios. You're not planning to take these things out for 20 years or longer. Some of the money's going to go 30, 40 years. So you, at your age, can continue to be relatively aggressive, particularly given your comfort level. So I stay with stocks.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome back to the show that's all about your dough. I'm Don. That's Tom. We're here to help you make more money.
Keep more.
And make more.
I guess.
Not riches more, but make more than in a savings account.
Actually, if you just took our advice about buying the right portfolio, rebalancing, and not doing anything, then according to the previously mentioned numbers, you would have made more. That's true.
You would have made more.
Yeah. Messing around,
because people mess around too much.
Yeah, right.
855-935-TALK is a very important phone number because it brings you to us every Saturday, making it really easy for us to talk about your money, which is what really matters. Your money, not ours. We're not sharing it with you. 855-935-8255. Let's go to Auburn, Washington. Nancy, welcome.
Hello. Yes, thank you for taking my call. I am in a condo, and I am considering selling the condo and moving into an assisted living situation, and using that money from the condo to pay for the assisted living. And then I have a brokerage account with a good amount in it that I will use, just keep for inheritance, if you will. Is that a good plan, do you think, or what would you advise me on that? I've been at the 25 years, and I am 89 years old.
Okay, so what I'm hearing, Nancy, is you sell the condo, you use the cash there to pay the bills, or just to get into the assisted living?
Is it a buy-in? Is it a buy-in or is it a rental?
No, it's a rental type. Yes.
Yeah, I mean, and if you have money in a brokerage type account, then that could make up. My only worry is people have a tendency to think these things are going to be linear. I just went through this a year ago when I ended up with 2 homes, and I didn't want to pay for 2 homes at one time, but I did. So there's no guarantee if you list your condo that you will sell it in a period of time. In fact, there's, as you may know, all kinds of crosswinds in the real estate market right now. So I wouldn't count on that. But if I had the backup of the brokerage account that I could pay the bills with that first, and then wait to sell the condo, I think that's a reasonable plan.
Okay. Well, as I said, I'm thinking of selling the condo probably by next summer anyway, and seeing if that could work for me.
It sounds like you're in pretty good health right now. There's no immediate health concern, is there?
Well, not immediate. No, I'm not in great health, but I'm not an immediate problem.
Okay. Yeah, and you're going to find it's going to be easier to sell next spring or summer.
Yeah, that's my take, too.
Yes.
So that's probably not a bad idea. It gives you plenty of time to plan. And then, you've got the backup, as Tom said. If the condo doesn't sell and you need to go into assisted living, you don't need to give that money to the kids or the grandkids. You can use it for you, which should be your number one priority. It should be
Absolutely. Yeah, take care of yourself. If anything's left, that's great. But otherwise, no, I think that's very well put.
Yeah, we're pretty much telling my mom, who's also 89, to spend everything.
Yeah, get it. Take care of yourself.
Okay, that's what my kids are telling me, too. So.
Good.
Yeah. Spend
the right thing.
Thank you very much.
Thank you. We appreciate the call. 855-935-TALK's the number.
I just laugh because people would tell you that, but I wonder if they really be thinking that. In other words, if I went to my kids and said, hey, I'm going to go crazy, I'm going to go on this, they'd be go, oh, go for it, Dad.
No, I honestly think that.
Thinking, okay.
I can tell you.
No, I'm saying my children with me.
But your
when
children are more greedy than I am, apparently.
You're going to just throw them completely under the bus.
I honestly, I've never in my life expected ever an inheritance.
Yeah.
Ever.
Well, you don't need one either, by the way.
Well, no, but even if I did, I would have very low expectations.
Yeah.
Of it. I mean,
and I got one, but you know what I did with mine, right?
You didn't spend it on me.
Yeah, I did. Actually, that's the money we started the company.
That's
where the money came from.
With it.
Yeah, we did.
That's right.
That's where the whole thing, the seed. I mean,
okay, you put it to good use.
Yeah. No, I think it's returned well. There was a lot of other work.
Look what we did.
It was not a passive investment. Let's put it.
No. But I mean, come on. Look at the impact this show has had.
Absolutely.
That Vestry and then Appella Wealth have had on people's lives.
Now you're going to make me want to leave more money to my kids because maybe they'll do something good with it. So I'll think that through.
Yeah, think about the Vanderbilt family.
Generation skipping.
It doesn't work out Cornelius did really well.
Yeah,
the kids,
really.
They just
built
the Biltmore.
And then they ended up blowing all the money within like 80 years or something.
Man, they blew it off very, very
crazy.
quickly.
Yeah.
855-935-TALK is our phone number. Lots of lines open. Lots of time remaining to talk about the most important part of your life on a day-to-day basis. Sure, there may be more important things in the interim, but it's money. Call us. We'll talk about it.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
With pretty much everybody at 855-935-TALK, 855-935-8255. I'm Don, that's Tom. And now, earlier, I got a note from our producer saying that he had a question.
He had a question.
Do we answer producer questions?
No,
Are we allowed to do that?
No.
Oh, okay. Well,
the line gets drawn. He's outside the line.
Are you sure?
I'm sorry.
We don't have any calls.
Okay, fine. Go ahead. What do you got?
Did you want to ask a question? You can turn yourself on, can't you?
I can turn myself on.
Oh, look.
Can you hear me?
Yeah.
There you go.
Lovely.
Oh, wow. You're on the air?
Wow. I'm on the air. Thanks for taking my call.
He's in our head
gentlemen.
again. This is really scary.
You're taking my call. Yeah, all right. Go ahead. Go ahead.
Starting to set up financially and get into investing, one thing I'm interested in is robo-investing, specifically the one offered by SoFi. It seems like a really good option, especially for someone kind of coming into it that doesn't fully know everything yet. And I just don't see any red flags with robo-investing, which kind of makes me nervous that I'm missing something. I was just curious what you guys thought about that whole side of it.
Now, robo-investing, of course, is just basically automated, money goes in, gets allocated.
Automated,
just rebalances, right?
Yeah, there's nothing, there's no downside to it per se. I mean, the reason I don't think it took off the way people thought it would a decade ago is it turned out that people needed more individual advice, really, than what they were getting from that.
Particularly when they're older, though. You're young, and therefore you really, basically, you just want somebody to allocate it properly and keep reinvesting the money that you throw in, right?
Yeah. And speaking of being young, right now I have it set up to just be an emergency rainy day situation, so I'm not touching it for a while, hopefully. I have it set up 80% stocks, 20% bonds. Is that a...
No, not in an emergency fund?
No, it's too risky.
Too risky. Yeah, because here's what you wouldn't want to have happen. Money set aside for car fix, whatever thing comes along, and then the market being down, so then you wouldn't have all the emergency money. So emergency funds really should be in things like money markets, high yield savings, things like that, where there's not much variance in the principal.
Okay, so emergency funds should just stay in a savings, probably.
Basically,
Absolutely. Emergency money should be in a high-yield savings account or a money market mutual fund of some sort. Money that is for 10-plus years, buying a house, retirement, that's when you really can start to get into equities, but you need to go in with the understanding that you are not going to touch them no matter what stupidity occurs in the stock market.
Yeah,
okay,
that's something you consider. And do you have any debt?
I have student loans that should be paid off hopefully in about 3 years.
And it's low interest, too.
What is the interest on those?
I'm not sure, but I'm hitting my payments is what I know.
Okay, that doesn't quite answer the question, but they should, if they're federal loans, they should be pretty inexpensive. If they're private, they could be more.
Yeah, all federal.
Yeah,
if they are higher than 5% a year.
I'd say then I'd be really cranking it up on those.
I'd be knocking them down, but otherwise...
Before I invested, that's what I was trying to get to.
Okay.
But just to let you know, SoFi has one of the better robos. They have a very low fee of 25 basis points, quarter of 1%. They actually have access to CFPs, real human ones.
Oh, there you go.
And they use ETFs, and they're pretty good products, and you just want to stay away from their alternative options,
which everybody's going to start throwing at you. So so to me, it would be the emergency fund, pay down those student loans, and then probably start investing. And if I was investing for the long haul, then that might be a Roth IRA, something like that, where it gets the tax-free growth.
Yeah, and is there any issues with a robo-Roth? They're kind of just the same?
Nope. No, it's the same thing. No, that's fine.
Nope.
I only have one other.
Your phone is really good.
Yeah, that's very clear. I only have one other request since we put you on for the program. Could you make sure Don's volume is 20% lower than mine? That was the original agreement, and nobody lived up to that.
I'm so sorry.
I really appreciate that.
It's been taken care of.
I appreciate it. Here he is. You can barely hear him now.
My volume down 50, and I can still match it.
Wow, this is my power finally. I've been waiting.
Thanks for the question. Yeah. We really appreciate it.
Thanks for taking it.
It's filling time, and that's an important thing to do on the radio.
Indeed it is, yeah.
As long as we don't have dead air. Just as long as there's no dead air. Like when Tom's power goes out. Which, by the way, is what happened in the last hour.
I know. It's crazy.
Tom's power at the lake house. It's because he's out in the middle of nowhere.
Yeah, I literally am. It goes out a lot here. But I have a generator, and the generator kicked right on, which is nice. But generally, I think now that I'm on fiber, it's a different situation. Because I went on fiber about a year ago. The fiber keeps working when the power's out. The power's still out, so the generator's running all this.
But the power, your modem there in the house still needs the power.
Yeah.
It needs the power.
No, I know, but that's getting from the generator. But in the past, even if you had generator power in the house, the internet would be down. Now with fiber, it still works. So miracles.
Thank goodness something in your world is 21st century. Because so much else isn't. We still have a lot of time, folks. We do, for you to get through to the show. Call us at 855-935-TALK. That's 855-935-8255. You can also send questions in at talkingrealmoney.com, and Tom has one of those that we may start before the break and finish after.
Oh, so you need something short here is what you're telling me?
Oh, or something short.
Yeah, I've got something short. It says, hi, Don and Tom. I've listened over the years.
Okay, thank you.
I'm curious, interested whether Don talks about how his wife is interested in individual stocks and maybe market timing. It seems so contradictory to what you preach. I wonder how Don and Debbie handle finances when they appear to have some differences in investing philosophies. Might help other listeners who have similar differences in investing philosophies. Thanks, and keep up the good work.
Well, one, we have our own accounts. She has her account.
Right, yeah.
I have mine. She has individual stocks, but she doesn't. Now, see, to be fair, she used to buy individual stocks. She used to be a broker.
Yeah, right, she was, yeah.
She used to be a broker, and I'm telling you, as one who came from that world, your belief is in the power of our predictive capability as human beings. Problem is, she's got a lot of these individual stocks that have large capital gains.
Hard to sell, sure.
So, yeah, they're hard to sell. She's not actively managing her portfolio or market timing anymore, although everyone.
So this is basically you're deflecting it. You're not going to answer the question. That's good. Good answer.
We have separate accounts. That's the answer. 855-935-TALK is our number.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Well, my wife listens to the show, unlike
I know.
Yours.
Well, my wife she's at the club working out. You know, I work out. We know when I work out, where I work out, right in the garage.
In your gym, yeah.
Yeah. You know, when she works out, she works out at the club. So,
yeah.
Talk about differences.
I got a note from Debbie.
We're not she asked me, and I told her we couldn't mention that. So
I haven't bought individual stocks in 20 years, she said.
Okay.
So she's listening.
I seem to remember a few years ago she was telling me there was one that you thought I should buy.
She didn't do it, though. She didn't do it. That's the thing.
Good enough. Good enough.
All right. Good enough.
Yeah.
855-935-TALK. Oh, wait. Look, we have calls now.
Please.
Robin Lacey's back for another quick question.
Wasn't enough to all in stocks? You want to know which stocks now?
Yeah. Go ahead, Rob.
Hey, guys. So my question is, I'm getting my TSP rolled over into my traditional IRA, and I have a Roth that's probably overcomplicated, so I'm looking to simplify. And my question specifically is, would I be better off with going with an S&P 500 fund or a total market fund for my core position? I plan to have about 30% in international and kind of spread that out between, different countries. So that's my question for a core fund.
How big is the IRA going to be? How big is the IRA going to be? How much money?
80,000.
I would just use a one fund, an AVGE or a DFAW. Either one is a global all equity fund. No reason to mess around. And by the way, the S&P 500, way too limited. That's 500 of the largest companies in the United States, of which now 40%, 7 stocks make up 40%. So, wow, that's concentration for me.
Yeah, just get the one fund. Don't make it too complicated. Okay?
Is there a comparable fund with Fidelity?
No.
Well, no, no, not the manner of which they're managed.
But if you have a Fidelity brokerage account, you can buy AVGE or DFAW because they're ETFs. They're not mutual funds.
Everybody's got them, so you could just either one of those would be fine.
Oh, okay.
Yeah.
Yeah, so you can buy that through Fidelity.
All right.
Okay. Good luck. Thanks for the call.
Thanks for the information. Appreciate it.
Our pleasure. Let's go out to New York. Rich, you're up. Welcome to the show.
Yes, hi, good afternoon. Thanks for taking my call. I agree with about 50% of what you two say, but I keep listening, so just so we know. However, about 3 weeks ago, I spoke with Tom, and he didn't believe something I was saying about an annuity. And I went back to the agent, as well as I brought the contract to my attorney to review, so I know I'm not going nuts.
Okay.
But basically, it was, I give $100,000, and I did this. I gave $100,000 to the insurance company, and they are going to credit the account 8% a year. It's a fixed income annuity, and then in 10 years, the crediting ceases, and then I could start by taking 6.75% of the balance, and it will remain for my wife and I, and it equates to almost $14,000 a year.
Okay,
so,
okay, wait, hold on. I'm trying to. I'm trying. This is a lot to take in number wise. So they're going to credit to. Now, bear in mind, crediting in an insurance policy usually means it's not real money. You can't take it because you have to annuitize to use it, right?
Correct.
Yeah.
It's like the phantom account, I call it.
Right. It's kind of fake money because they're running some numbers saying that we can pay you. Now, again, bear with me because here's the complexity of this. They're going to take and credit you with that 8% per year. So that's $8,000 the first year, a little over that each year for 10 years. So they're going to take you up to about $200,000, right?
Yeah, it comes to like $213 and change.
Yeah, $213. So they're going to take you to that, and then they're going to pay you 6.7% on that $213, right?
$213.
Right.
Yep. Right. Now,
but
my real account might only be worth $110,000.
No. Hold on. They're not actually paying you 6.7%. They're giving you some of your principal back.
That's fine.
Because,
but it's an income annuity, so it's income coming in.
Right, but you might find someone who will do an income annuity that will pay out in this day and age 8 or 9. Because it's not just it's not just an interest rate, it's partially return of principal. They're playing fast and loose with annuitization. They're playing fast and loose with actuarial tables. They're playing fast and loose with artificial money. They know that if you give them that $100,000, they're probably going to make, over that 10 years you've got it with them, that 8% back anyway in their investment portfolio. So there's no risk. So it'll be like for them, it's like paying you a portion of your $100,000. You could take your $100,000. And what would stop you from right now investing that money in something like an equity portfolio or a balanced portfolio that earns you 7 or 8% a year?
Absolutely.
And then in 10 years you own the $200,000 and you can do darn well anything you want. You could invest it in something that paid. We don't know what the interest rates are going to be in 10 years, but they could pay you say 5% per year, and you get to keep the principal. So
your money. Yeah,
it's a trade-off. There's no magic to annuities. There's nothing magical about them. They're paying you.
No, but you know what's magical? I'm going to tell you what's magical. And this is me. I mean, when I have about, I think, like $3 million in retirement, and we're okay. I even have a couple of pensions. However, when the market goes down, and it goes down 600, and I know the whole textbook, you leave it, it's just one day, it's a blip. I get a little bit of a knot, and I would be the type not to spend.
Then for you, Rich, annuities make sense. There are certain people for whom that certainty is important, and we are not opposed when it's an income annuity.
Tom and Don are talking real money.
Do you suffer from financial flinch reflex? Hi, I'm Don McDonald, and financial flinch reflex, or FFR, is a widespread condition triggered by watching too much financial news and not having a solid retirement plan. Common symptoms include doom scrolling, yelling at your portfolio, and considering gold bars, crypto, or your brother-in-law's startup. Markets don't cause panic. Not having a plan for them does. The best treatment? A real financial plan. One that's based on your life, not the latest headlines. And yes, we're talking to you, future retiree. Start your financial calming regimen today with a free, no-pressure meeting with an Appella advisor at TalkingRealMoney.com or call 800-386-3004. That's TalkingRealMoney.com, because a plan is the antidote to panic. Side effects of planning may include peace of mind, smarter investing, and fewer late-night CNBC binges. Please plan responsibly. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
All right, during the break, I ran really quick IRR calculations, really rough back in the
internal rate of return
calculations on that $100,000 in the scenario he gave me with the 8% crediting, which is not compounded, by the way, and the 6.7%. Okay. Yeah. So here's the deal. I came up with an internal rate of return of about 4% per year.
Which... Again, and Rich, I apologize if he talked to me earlier and I don't recall the conversation. And I told him I didn't like the product. I don't like it for the two things you just mentioned earlier. I'm saying 8%, but I'm really it's always so complicated to me. It's like, and why do I want to do that? So, but if you know, and you're very good, this is really good. If you know that you're going to get in knots when the market goes down by 20%,
know thyself.
You got to. And that's the biggest lesson we all need to know about investing, frankly.
Real quickly, let's go to Linwood, Washington. Ted, welcome to the show.
Thank you. I have a question about the gentleman holding our accounts. He moved from one company to another, actually to a bank. And I wondered if I made a mistake in following him rather than staying with the firm that originally had the money.
Was the firm that originally had the money a brokerage firm? Big brokerage firm?
Can I say the name?
Yeah,
sure.
Of course. It's America so far.
Ameriprise Financial.
Oh, yeah. You made a mistake twice.
Yeah. So Ameriprise is a broker dealer.
You made a mistake going with Ameriprise, and then you made a mistake following him to the bank where he's going to try and sell you something new because he needs a new commission.
And broker dealers are not required to act in your best interest 100% of the time as a registered investment advisor would. So, yeah, that's not a good move. Don't want to get into Ameriprise. We see some egregious things from there, but we'll just leave it at that.
And their fees are high. Even on their fee-based accounts, their fees are high. If I was you or in your situation, if you were asking me advice, I would say you need to leave the guy or gal, whomever it is, and you need to move your money to a truly 100% fiduciary advisor who's always required to act in your best interest, not when they feel like it.
The banks still have not arrived at that yet. I keep waiting for the day where I wake up.
There's too much money to be made in not being fiduciary.
Even credit unions where you trust them because you're a member and the fees are lower still have the broker in the lobby. It's
too much.
Awful.
It's too much money to be made. Yeah. They'd leave money on the table by becoming true fiduciaries.
Hate it. Really do. But okay.
Yeah. Well, I have to say that I've never had a problem of them supposedly taking away too much money. My funds have grown dramatically, and
well, so has everybody's. But both. Give me the name of one just because we only have a minute. Give me the name of one mutual fund or ETF you're in. Just one.
I can't tell you because I don't have the work in front of me.
Any of them from American funds? Any from American funds or PIMCO? American funds. They're charging you a 5 3/4% commission to get into those when you could go to Vanguard and get in for 0%.
And the expense ratio on those average about 0.60 when you can go to Vanguard and get it for 10 times less.
1/10, in other words. So it's not that they're doing anything egregious or illegal. That's not what we're saying. They're acting perfectly legally, and they're doing what they're allowed to do. But we don't believe that selling you a commissioned product when there is a non-commissioned product available is acting in your best interest. And by the way, the SEC even agrees with that. If there are two comparable products, they'd have to sell you the no-commission one if they were a fiduciary. Thanks for being there. We're out of time. We're talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.